post-crisis, as you know, it's been 10 years. We've had a lot of legislation. The dominant G20 movement to get mainly the banks re-regulated has many moving parts. The biggest and most successful parts, I would say, are in three areas. One is the capital requirements, which didn't require legislation anyway. And they've significantly improved the capital levels of the banks to the point that I think they're much less likely to fail. The second area is covered in legislation under Dodd-Frank and in MiFID, that is the Markets and Financial Institutions Directives in Europe, deals with derivatives markets and imposes much tighter requirements on central counterparties, trade repositories, and trading methods, and margin requirements. And I think, for example, Title VII of Dodd-Frank, dealing with derivatives, is generally agreed to be the most successful part of Dodd-Frank. And it's been quite a positive force for financial stability. And something that's not often mentioned, which I think is quite important, is the effect that it's also had on improved competitiveness in the derivatives markets, where you don't necessarily now have to go through a dealer bilaterally. You can request quotes from multiple dealers on a platform and get more competition for your trade request. The third area, which I think has been influential beyond the common discussion, is failure resolution. And as you know, these are rules that force the large banks to put themselves into a condition that makes it possible for them to be recapitalized over a weekend. Now, do I think that it's going to work? Well, I'm not so confident. But the fact that the regulations exist forces the banks to have a capital structure which is more suitable for failure resolution, and more importantly, forces creditors to internalize the costs that they might experience if a bank gets near insolvency. And you see that in dramatically higher credit spreads and wholesale unsecured funding for banks. Why is that important? Well, pre-crisis, banks would expand their balance sheets almost without hesitation to get a few basis points. And they could do that with unsecured funding that was very cheap because wholesale creditors knew that the banks probably wouldn't be allowed to fail. Now, despite much higher capital levels, the credit spreads on the banks have not gone down. They've gone up a lot. And that causes banks to think very carefully about what they want to load onto their balance sheets. The funding costs are quite significant. And that has both positive and negative effects. The positive effect is that the banks are much less likely to load up on risk and be a menace to the economy. The negative effect is if you need immediacy as a buy-side firm, banks are not going to provide it in any way that, anything close to the extent that they did before the crisis. So you have to find other ways to execute your trade, or you just have to be more patient if you have a large trade you want to execute.